Hi guys, welcome back to the channel Cracking Wealth. Thank you once again for tuning in. And you might be wondering, why are we looking at a US 30-year treasury chart? Like, isn't bond like a boring asset? Well, it is. But what if I tell you that there is a chance, or there might be a chance, to make a 100% return, 200% return, or even a 10x return on a particular ETF? We'll check that out and more later on in the episode. But first, we'll go over our Bitcoin analysis, which we made last week. If you haven't seen that video, please go back to the last week's video and check that out. Then we'll, of course, update you on what we were up to this past week. So, yes, jumping right into the Bitcoin charts, right? Last week we spoke about the death cross and how we expect the fractal from 4 years ago to repeat itself. Basically, we had said that Bitcoin's price in the next 2 to 3 months will fall, will likely fall, and our price target we gave was about 20,000 to 22,000. Right after we made that video, literally just a few minutes after, right, Bitcoin pumped. We made this video here a week ago, and Bitcoin pumped by over 5% to about $26,800. And some people might be wondering, is this the end of that? Was this a fake out or something, right? Look, we still believe in our theory, in our thesis, right? That this will still fall in the next 2 to 3 months. We're not short-term traders. We look at the long term and we go with that. The dead cross has been put in. As you can see, it's clear as day right now. So there's no doubt in that. In the next 2 to 3 months, we believe Bitcoin's price action will be weak, and it provides us an opportunity to keep scaling in our trade. And that's why we actually did not invest in any crypto this past week, because we're waiting for a lower price action. Nothing crazy, just 10 or 20% lower. So that is it, right? There's nothing new about this. We appreciated the pump actually. Here, I'll show you what we did in crypto. Actually, let's start with this past week. You can see in the past week we're up about $90. At some point we're up more than $250, as you can see here. And of course that's all thanks to crypto, really. As you can see here, at some point we're up above $200. But that's faded. That's faded in the past 2 days. It's come back down and now we're only up about $35. So like I said, that short-term trade, or that short-term movement in Bitcoin price, that's what it is. It's a short-term movement. We still believe that Bitcoin is going to go lower in the next few months before putting in back a golden cross. Again, repeating the same fractal from last 4 years ago. Okay. So here, we made no new purchases in crypto. We still have the same crypto portfolio. We will be making more purchases when this price action goes below, as we expected, right? So our portfolio here increased by about $300, maybe about $400, and that's mostly the $200 of recurring investing in our ETFs. Okay, nothing new here, just the same old boring $10 per day in each one of our 4 ETFs. And yeah, some price appreciation in crypto this past week and in those ETFs. By the way, the semiconductor ETF has been performing quite poorly this past few weeks, up 4% down, which is great because I probably got into it at the highest point, at the top, which to me, there is no problem there. We like it that way. We just want to get exposure to the semiconductor really sector, and it's a slow buying, so there are no worries. Talking about ETFs, there's one ETF I want to call your attention to, and this ETF, we will be coming into this ETF next week for sure. But let's analyze what we're looking at. We first started with this 30-year treasury chart, right? And I'm sure you were wondering what's going on. Let's talk about this, guys. So I don't know if you're familiar with the 60-40 strategy, which basically is you put in 60% in equities and you put in 40% in bonds. And the main reason for that was just to diversify your portfolio. So basically, right, equities and bonds have an inverse relationship. If equities are up, bonds are down. If equities are down, bonds are up. And this provided a relative stability to your portfolio. Okay. And here, this is a BlackRock research. They basically show this to you visually. Basically 10-year US Treasury returns on equity down days. So once equity is down, what did the 10-year bond do? US bond do? If equities were down 0 to 1%, okay, your bond was up about 0.1%. And this was true from 2000 to 2020. You can see from 2021 onwards, this relationship decoupled. We'll talk more about that. But yeah, as equities falls, right, the further or the harder the fall, the higher bonds rise. More than 1.5% fall, bonds are rising by about 0.6%, right? However, since the pandemic, this relationship isn't true anymore, okay? At least for now. So as equities fell, bonds also fell. And really, the reason for this could be a lot of things, but it's mostly inflation, high inflation, and the Fed aggressively hiking rates from 0 to 4%, or sorry, from 0 to 5% in less than a year and a half. But let's hear what the experts are saying. Then we'll talk to you about the opportunity that we're seeing.
Pretty darn resilient.
Yeah, well, at the peak of our cautiousness, we trimmed by 10%, and we kept all of our large tech holdings, and we now are back at full allocations with the market appreciation, but we're able to use that capital to redeploy into 4% tax-free muni bonds, which is an outstanding opportunity for our clients.
So you still think that opportunities outside of equities provide the best risk reward for you and your clients?
Yeah, at this time we think there's great opportunity in the bond market, which was uninvestable for roughly 15 years. And clients that had large equity positions that built up over the years, it's time to trim them and reallocate into other alternatives.
What about this notion?
All right, so you heard him. Great opportunity in the bond market that's been uninvestable in the past 15 years. I'll show you that in the charts in a second. But let's take a look and listen to Hara right here.
And I think I'm actually much less pessimistic on the 60-40 portfolio because while I think we're probably in a bit of a churn period here for equities, I mean, you've got the S&P 500 at 19 times basically, and projecting about 12% earnings growth next year. We think that's a little aggressive, especially given our relatively optimistic outlook for the economy, but still seeing growth being much more muted than it has been over the past couple of years. But fixed income, this is probably a really good entry point. And we've been talking a lot. We've been overweight to fixed income, talking about possibly, leaning further into that because as we see rates pick up and the outlook going forward, real rates have probably gone a little bit too far on too much optimism about the economy. We think we're probably more a 2% trend growth.
All right, let's stop right there. Basically, these two are optimistic on the fixed income, which is the bond markets, and they think that yields will reverse. Guys, so here's the relationship, right? The further these yields rise, let's go to the 1-year chart, right? From about 3.6%, 3.5% in December 2022, we're up to about 4%. So as yields rise, the bond prices fall. Okay, they have an inverse relationship. Just remember that. So looking back at our ETF here, as yields rise, this falls. Remember, from December, we're down here, 3.4, and now we're at about 4.4. Kind of the same thing here, right? Year to date, we're down 30%. Now, mind you, this is leverage. This is 3 times leverage, okay? I want to show you something. Here. Again, look at December, right? At some point, our yields were high. So basically where they are now, okay, around 4.4. Then it fell. It fell by almost 100 basis points, so about 1%, so 1 percentage points, right? So this is November to December of 2022. Take a look at this. November, from $6 to over $10. Okay? That's almost 75% rise as the yields fell. So what I'm talking about right now, the opportunity I'm talking about is the potential for yields to fall in the coming months and year. and the opportunity to make an outsized return through this leveraged ETF, this TMF. Okay. Now, I don't think that the yields are going to fall back to the lows of the 2020 during the COVID-19 when the Fed basically brought down interest rates to zero, basically, right? The 30-year yield at that time was probably around 1.3, if I'm not mistaken, right? Yeah, about 1.3, 1.2. I don't think that's going to go high. If it does go to that, if it does go to that low, right, you're talking about from $6 to basically 45, $46 TMF, right? So that's a return of almost 10x, from 5.6 to basically almost 50. Okay, so you're talking about 8 to 10x right there. I don't think it's going to go to that. But do we see yields coming back down to 2022, early 22 levels, around 3%, or around the long term? Really, when I say the long term, really the past 15, 20 years when bonds were uninvestable, so around 2.5 to 3%. Yes, yes, and I do see that coming in relatively soon, about a year to 2 years from now. Okay, I do see that happening, and I expect that this TMF should probably range anywhere from 10 to $25. And from here, 10 to $25 is anywhere from 100% to 4 to 5 times investing right now. Okay, this is a crude analysis, but that is what I'm looking at. That is what I'm looking at right now. And what gives me this backing? This is the CME Group futures market, Fed funds rates. Basically, this is what the Fed has control over directly. Okay, they directly set this Fed funds rate, and the next Fed meeting is in 3 days, 20th of September. Right now, the current target rate is 525 or 5.25%. Okay, and the market is predicting that the Fed will stay steady, leave the rates unchanged. Now, let's look at what the market is predicting a year and a quarter from now. The market is predicting by December of next year, 2024, that the Fed should have cut rates at least 3 times. Okay? Now, if this does happen, TMF should go up. Again, crude analysis, but this is the relationship between Fed funds rates to long-term yields, long-term treasury rates, and TMF, which is a leveraged ETF tracking a market value weighted index of US Treasury bonds with over 20 years of maturity. So yes, guys, that's the new trade, or that's the new investment that we're looking to make in the next week or so. All right, we'll update you on any moves as usual next week. Thank you once again for tuning in, and we'll see you on the next one. Bye-bye.